Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at Micron and Nike ahead of their earnings reports next week to consider if we should be buying the soaring AI stock and the beaten down retailer heading into their earnings or after their earnings reports. But before we get into everything, remember to subscribe and leave a review wherever you listen to podcasts, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Micron and Nike, I quickly just want to go over the broader market and maybe the near-term outlook for the market and the broader bull case as well before we jump into Micron and Nike. So the NASDAQ and the S&P 500 were sitting at new highs to close out the second to last week of June. I'm recording this on Thursday afternoon. And we did see then the S&P 500 and the NASDAQ take a little bit of a dip in the afternoon trading session off those highs, but still we're up huge so far this year, and a little bit of a pullback would make sense. The stock market's in the midst of also what could be a boring 3-week stretch until after the 4th of July, when the big banks unofficially kick off the second quarter earnings season on July 12th. There obviously are some big reports, including Nike and Micron, which are companies we're getting into today. And overall, the Fed is still set to cut interest rates, and the earnings outlook overall is really impressive. So that is why the bulls are continuing to push stocks to new highs. We're calling for overall, at Zacks, we're calling for overall S&P 500 earnings to jump 8.6% year over year in 2024. And then overall, we're calling for fiscal 2024 earnings to expand by 9.2% and then climb again in 2025 and 2026. So that's a pretty bullish backdrop. So the Fed's set to cut rates, and the earnings outlook looks really impressive, driven by tech and lots of other sectors as well. Nonetheless, investors shouldn't be shocked if we see a near-term pullback. Both the S&P 500 and the NASDAQ are trading at some rather overbought RSI levels, well above their 21-day moving averages. So at a certain point, there's going to be some water finding its level. So don't be shocked if in the coming weeks we see a little bit of a pullback to maybe recalibrate things heading into second quarter earnings, the thick of the second quarter earnings season, to then possibly march higher in the back half of the summer and into the latter part of 2024. So with that in mind, we're taking a look at Micron Technology, which trades in the ticker MU. It reports its Q3 fiscal 2024 results on June 26th. So as I'm recording this, Micron's down around 5% on Thursday afternoon. Still overall, its shares are up 75% in 2024 for the fifth best showing in the S&P 500. The memory chip powerhouse's outlook is improving within that cyclical sector of the semiconductor market. But now Wall Street's viewing Micron as just a larger play into the growing world of AI. It's one of the largest makers of memory chips in the world, and its offerings are found in PCs, smartphones, and other devices. Micron's also growing and had been growing through its expansion into data centers, EVs, and AI. And that had been happening for several years leading up to now. But now that the AI boom is in full swing, the memory industry is set to benefit greatly from the AI boom, and Micron's really going to be a big player. So they think that AI will drive record demand for its memory chips. The CEO said last quarter that our preeminent product portfolio positions us well to deliver strong fiscal second half 2024 results. And we believe that Micron is one of the biggest beneficiaries in the semiconductor industry of a multi-year opportunity enabled by AI. So they think their chips are going to play a big role in data centers, in all of the AI investment. And Wall Street's certainly taking notice. As I said, the stock's up 75% year to date, and its outlook, as we're going to get to in a second, looks really impressive. The firm also announced on May 1st that it was the first to ship what it calls critical memory for AI data centers to address rigorous speed and capacity demands for memory-intensive Gen AI applications. The company boasted its new offerings deliver more than 45% improved bit density, up to 22% improved energy efficiency, and a 16% lower latency over its competitors in that space at the moment. And then before that, the firm in late April said it was receiving up to $6.1 billion from the U.S. government to build 3 chip-making facilities, which was the latest in a slew of money the U.S. government's handing out to build more chips here in the United States. From the Wall Street Journal article at the time, the quote, the government will grant will fuel up to $125 billion in investment by Micron in New York and Idaho over the next 20 years, U.S. officials said. About $50 billion of that will come by 2030. Micron plans to build a, quote, mega fab, or a collection of massive chip producing facilities in Clay, New York. And the government funding will go towards building the first 2 of its 4 facilities that are expected to have chip producing space equal to almost 40 football fields. So they're rolling out a ton of manufacturing here in the United States, and its outlook is really impressive. So they're trying to capitalize on this AI boom just in the near term and for years and possibly decades to come. So right now we're calling for Micron to post 59% revenue growth this year in fiscal 2024, to go from about 15.5 billion to nearly 25 billion, and then another 51% revenue growth next year to get all the way up to 37 billion. This does come against a big down year last year in the cyclical space. So 2023 saw the company have a 50% decline on the top line. So it went from roughly 31 billion in 2022 to 15.4 last year, but it's going to get up to 25 billion this year in 2024, and then get all the way up to a brand new all-time high of 37 billion next year. And then on the bottom line, it's projected to swing from an adjusted loss of $4.45 per share last year, all the way up to 88 cents per share in 2024, and then climb 787% all the way up to $7.81 per share in 2025. So massive top and bottom line growth. And Wall Street's obviously a forward-looking world, and they're looking ahead to this insane expected growth from Micron. Overall, its earnings estimate revisions have been trending heavily in the right direction over the past year. And since its last report, its 2024 estimates up 10% since its last report, and its 2025 estimates up 12%. Overall, this helps it land a Zacks ranked number 2 buy at the moment. And then in terms of its stock price performance, and then possibly some entry points to get into Micron and some valuation levels, Micron's now up 375% in the last 10 years, with the stock up 75% in 2024 alone versus the tech sector's 25% climb. It's also soared about 165% in the past 2 years, and it's now trading slightly below its recent records. And as I said, it's falling rather significantly on Thursday afternoon trading. It might face more selling pressure in the near term, possibly heading into earnings or after earnings, since it's trading well above its 21-week and its 21-day moving averages, and at some rather historically overbought RSI levels. But a couple big down sessions over the next few weeks, and Micron could be sitting at an attractive entry point. For investors, it's 21-day moving average is sitting at roughly $132 at the moment, with its 50-day down at around $124. So right now it's trading at around $145. So if you see any of those moving averages get tagged, maybe that's when you want to finally jump into Micron after this big run. So, and if you're a longer term investor, maybe you don't want to exactly play this getting in at the market timing based on these moving averages. But if you see the pullback to that 21-day or all the way down to that 50-day, that could be a good time for both near-term traders and longer-term investors to take a stab at Micron, which, as I said, is a number 2 buy at the moment. And then in terms of its valuation, it's trading at a solid discount to tech. It's trading at 27.1 times forward earnings versus 28.5 times forward earnings, and at 4.9 times forward 12-month sales versus tech's 7 times sales. Obviously, overall, as I said, it could face more near-term selling pressure. The stock's up 75% year to date, but its long-term outlook, especially now that the memory chip sector is set to benefit so much from the AI boom, especially Micron, and they're building out fabs in the U.S. It's a great long-term play and near-term play. It has a great balance sheet, and 24 of the 27 brokerage recommendations Zacks has are sitting at strong buys. The company also pays a dividend, so Micron's certainly worth putting on your radar heading into its earnings release next week. And as I said, if it has more of a near-term pullback to that 21-day, 50-day, or if it gets all the way down to the 200-day, I'd say that's a screaming buy for Micron. So certainly worth considering heading into that earnings release. And now we're going to look at a company that operates in a totally different area of the economy that's actually been hit really hard this year, but it's also reporting next week. So that's Nike, and it's reporting on Thursday, June 27th, and they're set to report their fourth quarter fiscal 2024 results. So they're on a strange fiscal year calendar. The stock is down 45% from its all-time highs heading into that fourth quarter release. Wall Street's dumped the stock for numerous reasons, but the footwear and apparel company remains one of the heavyweights in the space around the world, and it might be time to consider buying Nike, especially as a lot of the rest of the market gets a little overheated. So let's take a look at some of the setbacks and then what to expect in the near term. So relative newcomers such as Hoka and On are challenging Nike in the running shoe segment and forcing it to adapt quickly to regain some of its lost market share in key demographics in that running shoe space. At the same time, Lululemon and Adidas and tons of new digital focus upstarts are slowly chipping away at some of its dominance in athleisure and streetwear and things like that. So Nike's no longer the top dog it once was. It also got caught up in the broader consumer discretionary sell-off. Higher rates and changing shopping patterns in that post-pandemic boom have now faded. So the broader Zacks consumer discretionary sector is down 33% in the last 3 years. First, the S&P 500's 30% climb. So Nike's getting hit along with that entire sector. So Nike's not an outlier by any means. Wall Street's growing a little bit more concerned about its pandemic era pivot to go all in on digital and direct consumer. And some investors are also questioning Nike's direction under CEO John Donahoe, who took over from longtime boss Mark Parker in early 2020. So actually right as the pandemic was changing shopping patterns and forcing Nike to try to do this all in on direct consumer push. The company offered disappointing guidance in the second quarter, so 2 quarters ago at this point, citing increased macro headwinds, particularly in Greater China and other areas. They're adjusting some of their digital growth plans based on recent digital traffic softness and higher marketplace promotions, lifecycle management, and other key product franchises and stronger U.S. dollar. So lots of headwinds in the near term. Thankfully, though, it came in stronger than expected last quarter, which was Q3, its bottom line, and it's attempting to cut a bunch of costs and help it slowly return to form by focusing on things that its core competencies, and as I said, getting back to streamlining its business overall. So the company's trying to save up to $2 billion over the next 3 years by simplifying product assortment, improving supply chain efficiency, boosting automation, streamlining organizational structure, and reducing management layers. So just trimming some of the fat and getting back to what it does best at all aspects of its business. So it just faced some near-term setbacks and it went on a booming run. So if we look ahead to what to expect overall, its 2024 results, as I said, it's about to report its fourth quarter 2024 results, are expected to climb roughly 1% on the top line, and then expected to do about 1.5% growth next year. So some subdued top line growth for the next 2 years, but on the bottom line, we're calling for 16% growth and then another 5% growth on the bottom line next year. It is worth noting that this is coming after a really impressive 3-year stretch. So it did 19% growth in 2021, 5% growth in 2022, and then another 10% growth last year. So this sort of sideways top line is coming against a really impressive 3-year stretch. So it's kind of only, it just was bound to happen that it couldn't keep growing at 10% when it's a company of the size of Nike and just being so entrenched around the world. It's not going to be able to do those kind of numbers for that long. So it's returning to bottom line growth, and it's set to bounce back on the top line this year and next year, even though it's only going to do roughly 1% growth each year. And then in terms of its earnings revisions, they've kind of stagnated recently. So over the last year, its overall 2024 estimates up roughly 1% from where it was this time last year, with its 2025 estimate down around 9% over the last year. So that's a big part of the reason why the stock has fallen so much. As I said, it's down around 45% from its all-time highs. It's also now trading roughly 20% below its average Zacks price target at around $95 per share. So tons of longer-term upside if you have any confidence in Nike as a business, not just 5 months from now, but 5 years from now and longer. Overall, the stock is still up 640% in the last 15 years to easily top the S&P 500, which is up 515%. And the stock was really crushing the broader benchmark until the last 3 years, with it down around 27% over the last 3 years versus the index, the benchmark, 30% gain. In terms of some of its moving average, it's back above its 21-day and 50-day moving averages, but solidly below its 200-day. And it recently got bounced back down off its 21-week moving average. So these longer-term moving averages might be where, if investors who focus on any of these technical levels, moving averages, might want to look at that 21-week. If it's finally able to bounce up back above that 21-week, it's been rejected there a few times so far this year, and including twice recently. So that could be a line in the sand that if it gets above there, it could be finally ready to break out. It's essentially moved sideways over the last 5 years. It's now trading, around where it was in late 2019. And on the valuation side, it's trading at a 10% discount to its 10-year median at 24.7 times forward 12-month earnings. And it's also trading at a 50% discount to its highs and solidly below, I said, it's solidly below its 10-year median. And its dividend yields about 1.6% at the moment. Nike is currently a Zacks ranked number 3 hold, as I said, because of those earnings revisions activities. And the stock's trading at a strange technical level, so maybe you don't want to get in right now and try to exactly bottom hunt, because they're especially around an earnings report, they could come out with really disappointing guidance. No one exactly knows what's right around the corner. But in the long run, Nike does seem to be at a place where investors who have confidence in the business several years from now, maybe even several decades from now, might be ready to get into that beaten down stock, especially as the broader market's getting really overheated in the near term. Wall Street might start taking some profits on some of the AI stocks, like even Micron, and start putting that money in some beaten down names in the near term. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.